Every gambler knows that the secret to surviving is knowing what to throw away, knowing what to keep. 'Cause every hand's a winner and every hand's a loser, and the best that you can hope for is to die in your sleep.
In this chapter, we are going to discuss risk and reward. If you have gone through the last chapter, you know money management is the most important thing in trading success, and the most important thing in money management is managing risk-reward. Why most of the people lose money in trading? Because they give too much importance for predicting the direction of the market, and not really concerned about risk-reward. In Forex, we know that Euro-USD pair has a spread of 2 pips normally. That means we are giving 2 pips as commissions. Let us analyze what this 2 pips means in 4 different scenarios. Scenario 1. We have a trader who is looking for 100 pips profit, or he has kept a limit of 100 pips and a stop loss of 100 pips. In this scenario he is having a commission of 2 pips. Let us see how much percentage he is spending for commission for the trade. Calculating risk-reward and relating it to success rate is readily available in the internet. You can Google it and study if you are not aware of that. 2 pips equals 2% of 100 pips. So he is spending 2% as commission. And the risk-to-reward ratio here is 1.02:1. Normally ratios are integers, but here for the sake of understanding I have put it with decimals. It also means that you have to win 51% of the trades in order to break even. Now, Scenario 2. We have a trader who is looking for 40 pips profit, or he has kept a limit of 40 pips and a stop loss of 40 pips. In this scenario he is having a spread of 2 pips. Let us see how much percentage he is spending for commissions for the trade. 2 pips equals 5% of 40 pips. So he is spending 5% as commission. And the risk-to-reward ratio here is 1.05:1. It also means that you have to win 53% of the trades in order to break even. Now, Scenario 3. We have a trader who is looking for 20 pips profit, or he has kept a limit of 20 pips and a stop loss of 20 pips. In this scenario he is having a commission of 2 pips. Let us see how much percentage he is spending for commissions for the trade. 2 pips equals 10% of 20 pips. So he is spending 10% as commission. And the risk-to-reward ratio here is 1.1:1. It also means that you have to win 55% of the trades in order to break even. Now let us take for example, dumb traders who trade for 2 or 3 pips. Scenario 4. We have a trader who is looking for 4 pips profit, or he has kept a limit of 4 pips and a stop loss of 4 pips. In this scenario he is having a spread of 2 pips. Let us see how much percentage he is spending for commissions for the trade. 2 pips equals 50% of 4 pips. So he is spending 50% as commission. And the risk-to-reward ratio here is 1.5:1. It also means that you have to win 67% of the trades in order to break even. Winning 67% of the time is impossible in the long term. Good fund managers and other traders who does make money have a success rate less than 45%. They depend on money management to balance it. Now if you look at the last scenario, this is what happens to day traders who doesn't understand risk-reward. They may win more number of times, but still they will end up wiping off their account. I'm going to show you an example here. How to turn losing account into a winning account. 1000 trades. The trade outcome remains the same. We will see the magic of risk-reward. In this first image I am keeping the risk-reward as 1:1. And you can see it made a loss of $45,000 from 1,000 trades. The success chart shows that most of the trades were losing trades. Now here in the second image shows everything kept same but risk-reward was changed to 1 is to 1.1. That means, for every $1, we win $1.01, or lose $1. Now see, the losses in equity has drastically came down to minus $10,000. Now in the third image we change the risk reward to 1 is to 1.2. That means, for every $1, we win $1.02, or lose $1. See here, even though most of the trades were losing, we stand profitable by $15,000. Now in the fourth image the risk reward is changed to 1 is to 1.3. For every $1, we win $1.03, or lose $1. Our profits have skyrocketed to $35,000. This is how we turn a losing account into winning account. Easier said than done. There are other trade practices to be mastered before you can make a good risk reward. There are things like martingale, reverse martingale, equity stop levels, fixed ratios, fixed rates. Everything has to be put together to get the best out of money management. We at AutomatedWealthManagementTool.com has the best mentoring program in business. We teach you how to master money management so that you come out as a winning trader. Knowing to trade and not knowing how to trade makes all the difference.